Hi team, and welcome to another video for tutoring. Today we're going to be going over chapter 1, which is basic insurance concepts and principles. I'm going to go ahead and share my screen. Give me just a moment. I hope you all are doing really well with your studying and you're getting everything going. Perfect. Alrighty. So for chapter 1, basic insurance concepts and principles, we're going to be going over the basic terminology that's going to allow you to understand on the test what the questions are asking, right? So for a lot of people, insurance is almost like a whole nother language, right? A lot of us don't normally use these words in regular conversation. So we're going to have to learn a lot more terminology and kind of make it common sense for ourselves. So first thing I'm going to do is go over the terms to know. So the first term to know is going to be what is an agent and a producer. So they use the word agent and producer kind of interchanging back and forth, right? They like to sometimes call us agents, sometimes call us producers. So whether you hear either one of those words, an agent or a producer is the life insurance agent, the person with the license who is producing the insurance document, right? So the person who is selling the insurance is the producer of the insurance. So an agent or a producer is a legal representative of an insurance company. They work for the insurance company. And the reason why that's important to know is because a broker is opposite of that. In our test, a broker is able to work kind of on the client's terms. So they're able to choose different companies to provide different products. And so an agent or a producer works for the insurance company. A broker works for their client. They are not necessarily tied in with any one company. They can represent multiple companies. Okay. Next one is an applicant or a proposed insured. So an applicant and a proposed insured are the same thing. This is the person applying for the insurance. The way that you need to think of it when you see proposed insured is this person is proposing, they're asking to be covered, to be insured. Okay. Next one is going to be who is a beneficiary. A beneficiary is simply the person who receives the money in a life insurance policy. Okay. In a life insurance policy, because in annuities, it's called something else, but we'll get there in time. Indemnity. Indemnity means that the insured cannot recover more than their loss, meaning the insurance company is only able to pay off what has been lost, bring it back to its previous financial situation to the best of its ability. And I know that doesn't make a lot of sense right now, but when we get to the part about indemnity, there's some pictures that'll kind of make it a little more clear. In life insurance, it doesn't necessarily work that way, but with auto, with health, with home insurance, it does work that way. With life insurance, it doesn't, but we need to know for our test. Next, we have insurance policy. An insurance policy is a contract between the company and the policy owner, right? That's pretty common knowledge. But what I want you to know about the insurance policy is that it sets forth the insurance contract. The policy sets forth to the contract or the contract. It says it in your test. I've seen it many times. So insurance policy sets forth the insurance contract, right? You need the policy in order to be approved to get the actual contract, the actual how do you say that? The actual insurance policy, like in your hand, right? So insurance policy sets forth the insurance contract. Next, we have insured. Who is the insured person? This is the person covered by that insurance policy. Okay. Does not necessarily have to be the applicant or the proposed insured, right? I can apply for my children, but my children are the insured individuals. I was the applicant. So it doesn't have to be the same. Whoever's name is on that policy is the insured person. Who is the insurer? Insurers, right? This is the company. They are doing the insuring, right? They are insuring us. So the insurer is the company. The insured is the person on the contract. Okay. They like to use all of these words that have the letter I. So insured, indemnity, insuring, all this. They use all these words that sound a lot alike in one sentence. So we need to know off the top of our heads very quickly the difference between an insurer, which is the company, and the insured, which is the person being insured. Okay. Next is the law of large numbers, but we'll talk about that when we get to that section. We also have a policy owner. A policy owner is the person who is paying the premiums. This is also the person who has all of the rights and privileges to this policy. Okay. Yes. The policy owner can be an owner and not be the insured person. Okay, and we'll go over that more. Next, we have premium. A premium is the money paid to the insurance company in order to keep this policy active, right? Whether it's monthly, quarterly, semi-annually, or biannually, I can't remember which one they use for that, or annually, does not matter. Whatever you pay for this insurance policy is a premium, okay? And then reciprocal. Okay, we will be going over this more as well, but this just means that there's a mutual understanding between the company and between the policy owner. They basically they promise, right, to do certain things, and they both have certain rights and privileges in this contract. So I think they call it reciprocity, I believe so, reciprocal, but it's an exchange of, or an interchange of rights and privileges in an insurance contract. All right. So for insurance, we're going to be going over the definition of insurance, which we do need to know. Okay. So insurance is a transfer of risk of loss from an individual or a business to an insurance company. Okay. Regular terms. Insurance is the transfer. It is the giving the risk of loss to the insurance company. Example, I personally, right? Let's just say I'm looking for car insurance, right? Car insurance. I cannot afford, if my car got damaged in a big accident, let's just say it totals out, somebody hit me. I can't afford to fix it or to replace it on my own at the drop of a dime, right? Imagine just getting crashed, your car's totaled, and then having like $90,000 the next day to go buy a brand new one, right? We don't have that. Normally it does not, that's not something that we have. So what people do is they purchase insurance. Okay. They pay the insurance company to protect their vehicle, to give them money to replace it, to give them some kind of benefit to fix it, something like that. So we are transferring, we are giving this risk to the insurance company. And we're going to be talking about transferring risk later on. Okay. Next thing I kind of want to go over, and like I said, for these chapters, they give it to you in a really good condensed little portion. So I'm just going to be hitting the main portions on here that stick out to me. For you, go through here and really look at this information for your test. Next is going to be a person. What is a person in the eyes of the law? Okay, so in the law, a person is a legal entity which acts on behalf of itself. Okay, this makes a person in an insurance contract, right? It has to be some type of thing that falls into this category. So persons can include individuals, right? Human beings. It can include associations, organizations, corporations, partnerships, businesses, trusts. But notice that one thing is not in there, and this is what is going to be the trick question on your test. Notice that it doesn't say family, right? Family is not considered a person in the eyes of the law. So in the eyes of the law, person can be pretty much a lot of things, right? Other than like a pet and family. But on the test, it literally has a question on there. And I've had several recruits come and tell me the same thing. They're like, hey, Carly, you were right. They asked me that question. A person in the eyes of the law can be which of the following, or cannot be which of the following. And it'll say associations, organizations, partnership, human beings, family. And in our head, we want to say, hey, people, like a family is persons, right? Wrong. A family is not a person in the eyes of the law. Only those things there. But really, that's only going to be one question on your test, but it's one that has come back a lot and let us know, hey, this is something that we should go over. Okay. All right. So, like I said before, insurance, right? Insurance is the transfer of risk of loss. You need to know that little statement there. Insurance is the transfer, giving of risk of loss, the possibility of a loss occurring. We're giving that to someone else, okay? Know what the definition to insurance is. And then this is how it kind of works overall. We have a policy owner. This person pays the premium to the insurance company. The insurance company then issues the policy to this policy owner and pays the benefit to a beneficiary if a loss occurs. A loss can be a lot of different things, but for life insurance, it would be a death, right? In car insurance, it would be a crash. In home insurance, it's a ruined house. So that's what a loss is, okay? Then this benefit gets paid out to a beneficiary. This beneficiary receives benefit upon the insured's death. So that's kind of how that goes. Next, we're going to talk about types of risk. So there are two types of risk. There are pure risks, which are the only types of risk that are insured or insurable. Okay, so if on your test it says, which of the following types of risk is insurable? Pure risk. Okay, so risk is the uncertainty of a loss occurring. We don't know if we're going to get into a car accident. That's the risk. Okay, that's what the definition of risk is. The uncertainty or chance of a loss occurring. Pure risk refers to situations that can only result in a loss, no change, right? Meaning we can't make money off of this issue. Okay, like I said, life insurance works differently. Don't look too far into it, just know the definitions. Pure risk is pure loss, only loss. There's no chance for gain, okay? Pure risk is the only type of insurance that insurance companies are willing to accept. Okay. Now, you're probably thinking, well, what is not pure risk? I'm going to tell you. It's called speculative risk. So speculative risk involves the opportunity for loss or gain. Okay. For example, gambling. We cannot insure sums of money that you could lose and you could gain from, right? Every time you gamble, you possibly could hit big, but you also could lose it all, right? So there's no way to ensure this because there's no statistics around it, right? These type of risks are not insurable. So types of speculative risk would be gambling, horse races, some types of investments, right? That's not insurable. No. The only type of risk that is insurable is pure risk. Next, we have perils and hazards. So keep in mind, all of this is talking about the very base of insurance, right? So perils are causes of loss that are insured against in the policy. So causes of loss, death, that's a cause of loss, right? How about with home insurance, a fire, right? That's a loss. The actual car accident, the thing that causes the damage is the peril. Okay, think of peril as death. Like, oh, I periled, I died. That's technically what peril is. Peril is another word for death. But anyway, that'll help you remember, right? Any way that you can find little tips and tricks to remember these words is going to help you when it comes to your test. So peril means, right? Peril is the cause of loss. It's the actual fire, it's the actual car accident, the actual death, right? Then we have hazards. Hazards are conditions or situations. They're things that increase the chances of a loss occurring. Okay? Example, someone leaves their stove on when they leave their house. That's a hazard. Someone's driving to work. They're running late and they're speeding, right? They're driving like recklessly on the freeway and they're putting on makeup in their mirror. Hazard, right? Because you're not paying attention. It could increase the probability of a loss occurring. Okay. Now, hazards being conditions or situations that increase the chances of loss, there are 4 types that we need to know. 3 that we need to know. 1 is it's dumb. So 3 that we need to know, 1 that we don't really, but we're going to go over them. So first type of hazard is a physical hazard. This is something that's physically wrong with us that can cause issues later. Okay? Physical hazards are individual characteristics, right, that increase the chances of a loss occurring. Physical hazards exist because of a physical condition, right? Past medical history, conditions at birth, such as blindness. Like, imagine being blind. I have a blind grandpa, guys, and he does a lot of reckless stuff. He really does. He thinks that he can still, like, fix his car. He thinks that he can, like, clean the solar panels on his roof, and he's blind, right? Can we all agree that blind people have a higher probability of a loss occurring? They can fall off that roof. They can walk into the street and get hit by a bus. Those are physical hazards. Maybe someone who has heart disease. That's a physical hazard. That's something wrong with someone physically that can cause a loss to happen quicker than a regular healthy person, right? So those are physical hazards. Next, and you're going to need to know the difference between these 2 hazards because these are the ones that they're going to test you on. Physical's easy, legal's easy, but moral and morale. Okay, moral and morale. We need to know the difference between the 2, even though only one of them has an E at the end. They both look the same, but they don't mean the same thing, okay? Moral hazards are tendencies towards increased risk when it comes to lying, when it comes to fraud, when it comes to someone's credibility. I'll say credibility, right? A moral hazard has to do with your morals, your internal beliefs, right? I don't know if you guys have ever been told this, but this is the way that I remember the difference between moral and morale. When I was younger, people used to tell my mom, "Oh, your kids have great morals. You're doing a great job." Meaning we don't lie, we don't cheat, we don't steal, right? We're good people, right? So moral hazards, this refers to those applicants who might lie on an application, right? Or in the past, they've maybe submitted fraudulent claims against insurers to try to get money or get something out of it. Okay, so moral hazards are for liars, cheaters, thieves. Okay, morale, morale. Those hazards are similar to moral hazards, but they're not intentional. They're just people being like, I'm blonde, so I can say this. It's people being like blonde, like ditzy, like not thinking that what they do will affect them. Okay. So morale hazards are similar to moral hazards, except they arise from a state of mind that causes indifference to loss, right? Example, I'm one of those people that when I was younger, I would always forget to lock my house, like lock my door, because I didn't grow up that way, right? That puts me at a higher hazard, right? A higher risk of being broken into, right? I am also one of those people that don't quite pay attention to my surroundings sometimes, right? I don't know if you guys have ever seen those people that like they'll be crossing the street and texting at the same time, like there aren't cars that can literally hit them. Those are people with morale hazards. Those are the morale hazard people. Because they're not attempting to put themselves in danger. They just don't think that what they're doing is putting them in danger. Okay. So morale hazards, right? They can be seen as carelessness. Okay. So moral hazards, lying, cheating, stealing. Morale hazards, carelessness, ditziness, kind of negligent, right? Not really paying attention. That's those people. Okay. And then legal hazards has to do with people who may have the specific definition of it says that it describes a set of legal or regulatory conditions that affects the insurer's ability to collect premiums. What they're saying is people who are prone to bankruptcies, people with horrible credit, people with a bad track record of keeping their policies. That's what that's talking about. Okay. But they're going to ask you about moral and morale. Next, we have law of large numbers. So the basis of insurance is sharing risk among a large group of people, okay, with similar exposure to loss, okay? A homogeneous group, right? Homogeneous meaning the same. This is going to be a group of people with similar things going on, similar age group, similar medical history, similar demographics. Okay, that's a homogeneous group. The law of large numbers states that the larger the group of people, right? The larger the group of people with the similar exposure to loss, the more predictable this loss can become. When we're thinking about life insurance, okay, we have age groups, right? We have these different groups of people. So take me, for instance. I am 32. I'm 32. 32-year-olds with pretty decent medical history, right? Their chance of loss is much lower than someone who's maybe 68 years old with poor health, right? So the law of large numbers is going to allow the insurance company to come up statistically with a number that's going to tell them how often this loss is going to happen within that group. Okay. All you need to know for your test is that the law of large numbers just states that the larger the group, the more predictable the loss will become. Okay, meaning they can see it coming easier with a larger group of people. Okay. Next, we're going to talk about exposures. Okay, exposures. This is a unit of measure that the insurance company uses. And for all you new people, because you guys are all new, right? Know that some of this stuff doesn't make sense. I know that it does. And I'm going to take a break halfway through this to let you know that. I know that it doesn't make sense, but I promise you it will. Okay, so don't think, oh my gosh, like this stuff it's not going to click. It will click. Just continue to test, continue to test. Once you see these words more often, it's going to make sense. Okay. So with that being said, exposure is a wild definition. It doesn't make sense in the English language, but in insurance it does. So exposure is a unit of measure, okay, used to determine rates charged for insurance company. Now, what can they give us, or what can they base this off of, right? So in life insurance, all of the following factors are considered when determining how expensive our life insurance is. The age of the person, biggest factor. Medical history, right behind it, right? What they do for work, yes, that's a real requirement, like kind of statistic, right? So what they do for work, and sex. Now, that means whether you're a male or female by birth, okay? By birth. Men have statistically higher premiums than women because women statistically live longer than men. You have to remember that insurance is a business and everything runs off of statistics, okay? So how do they come up with these exposures, right? So our age, they're going to give us a certain unit of measure. Our medical history, whether it's good or not, is going to give us a certain unit of exposure to loss. Whether we work, I don't know, in the oil fields in the ocean or whatever that is, those ocean rigs. I had a client that applied for insurance and couldn't because he literally does the most dangerous thing on earth, right? So these are all things that come into play when it comes to coming up with premium. And the insurance company, this is like that backdoor stuff. This is what they take into account. Us as agents only kind of have to do our best to find the best people, right? The best people. We don't want to look for someone that's super old. We also don't want people super young because it's not good for the insurance company. So exposure is a unit of measure, right? Determined the rates of charge for our insurance. Now, while we're talking about what can be considered as for like when we will be denied or accepted with insurance, age, medical history, occupation, and sex. Okay, those are them. They will ask you on your test, and they're going to put sexual orientation in there, right? Orientation. That does not mean whether you are a female or male. Just to point that out. That does not mean that. It means who you like love, that's not the same. So when you see that, if you see that on your test, you'll know right off the top, hey, Carly told me these are the things that are taken into consideration. Sex, yes, is taken into consideration, but sexual orientation is not. Also, yes, I'm just going to leave it there, but sometimes background as well, not a factor. In some cases it is, but that's what you need to know for that section. Age, medical history, occupation, and sex. Those are the only things they can base us off of, not race either. no for race, no for sexual orientation. Okay? All right. I already went through what homogeneous means as well. So now that we've talked about hazards, perils, loss, right? We've talked about all these things. This is in the order of which it goes, okay? Hazards start first. Hazards are conditions or actions that cause us to be at an increased rate of loss, right? We put ourselves in a higher probability of loss. That's a hazard. Perils are the actual causes of loss. The loss is the loss, right? Death, house fire, tornado. And then insurance kicks in, transfers that loss, and then they protect us from having to pay it out of our pockets. Here is one to wrap it all together. Hazards. I am running late to work, right? I'm driving in the car and I'm speeding. This is already a hazard, right? My car hits another car. There's your peril. Okay, that's the actual thing that caused the loss. So I'm speeding, that's a hazard. I hit a car, that's the peril. My car is now totaled, that's the loss. Insurance company gives me money, that's the protection. Okay, boom, 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 boom. That's the order of those things. All right, perfect, 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 perfect. All right. Next, we're going to talk about adverse selection. No. Adverse selection can be a little bit tricky to explain. A profitable distribution of exposures, before I go to the next one, this has to do with adverse selection. So a profitable distribution of exposures or spread of risk, meaning they don't want everybody to be on the same plane. Right? They need some sick people, some healthy people to balance that out, some in the middle, all different age ranges. We need a spread of risk. We want lots of different types of people. So a profitable distribution of exposures exists when poor risks, right? Elderly people, sick people are balanced, right? With preferred risk, which would be the healthy people, right? And average people in the middle, meaning everything is spread out. We want a profitable distribution of exposure. Okay. The purpose behind this is so that we can protect the insurer, right? The company against adverse selection. The word adverse means negative. Okay. Adverse means negative, negative selection, poor selection, bad selection. Okay. So insurance companies strive to protect themselves from adverse selection. The insuring of risks that are more prone to losses than the average risk, meaning us as agents, let's just say we go and we're like, you know what? Florida is probably hopping with policies, right? All these retired people, all these people that are like 60 plus, they need life insurance. We're going to go and write up all those people. That's not a good thing. At least not for the insurance company. For us, it might be. But for the insurance company, it's not necessarily, right? Because these people are very prone to loss. Like they're literally retired. They're going to pass away sooner or later, right? And it's probably sooner than later. So what we want to do to protect the insurance company, to protect from bad selection, poor selection, adverse selection, we want to insure some younger people, some 30s. We want lots of 30s, right? Lots of 30s, 40s, and then some 60s, 55s, right? We want to spread it out so that the insurance company isn't at a loss, Imagine having to pay out so many policies for all of these elderly people and not having enough people to pay premiums to keep it all up, right? That's when you become insolvent, basically bankrupt. Yeah. So adverse selection means the agents did poor selection, and the insurance company wants to prevent from that. They want to protect themselves from adverse selection. The way they can do this, okay, to protect themselves from this is going to be to refuse or restrict coverage, right? People with poor medical history get denied. And this is to protect the insurance company from adverse selection, right? So they can get denied, right? Refuse coverage. They can restrict coverage, meaning, okay, we'll give you coverage, but only 150,000. Like, we're not doing 500,000 because, your medical history. So we're going to do that, or no insurance. So they can give restrictions for bad risks, right? For people that are older, are sickly, have bad history, something like that. Or they can charge them higher premiums, right? They can charge them a higher rate for insurance. That's why the older we get, the more expensive our premiums are, because there's a higher probability of risk. We don't need that section. All right. Now we're going to talk about risk management. So we talked a lot about risk, right? The probability, the chance of a loss occurring is risk, right? So risk is a big word in the insurance industry, and we're going to go over some of the management techniques. How do people manage risk? And these you will need to know for your test. First way, we can share risk. We can share the risk. Okay. Sharing is a method of dealing with risk for a group or individual persons or businesses with the same or similar exposure to loss, meaning they all got the same demographics going on. They will share the losses that occur within that group. Okay. It's basically like insurance, but without the insurance company. Okay. Sharing means these people are going to share the risk with each other. If something happens, then they're all going to pitch in to fix it. Okay. Reciprocal insurance is a formal risk sharing agreement. We'll be going over that later, but reciprocal insurance means there's two companies, right? And they go into a contract with one another where they promise to reciprocate coverage to each other. If something bad happens to A, then B is going to step in and help. If something bad happens to B, A is going to step in and help. Okay, that's reciprocal insurance. They're going to work in tandem. Okay, so sharing. That's mostly all you need to know. Sharing, right? Sharing is when a group of people basically share the risk within each other. They don't have a company that's doing it. Second, transfer. This is the most effective way to manage risk. Transferring risk of loss to a company, right? Or to another party is how they say it. This is called insurance, right? So insurance is the transfer of risk of loss. That's the definition of insurance. So transferring it means I am going to take this loss and I'm going to transfer it so that they can bear the risk and I don't have to worry about it, but I'm going to pay them a fee. Okay. Insurance is the most common method of transferring risk, and the individual or group usually transfers it to the insurance company and, like I said, pays a fee. Okay. There it goes. Next one is avoidance. avoidance is quite literally what that sounds like. And you're going to see this one on your test. So one of the methods of dealing with risk is avoidance. This just means we are going to avoid the loss altogether, right? We can do it, but it's seldom practical. So let's just look at, let's just say I never want to die in a plane crash. Knock on wood. I don't want to die in a plane crash. I will simply never get on a plane, right? But this doesn't handle all risk. So it's like I never want to die in a car crash. I'm never going to get into a car. That's avoiding the problem. Okay. So avoidance can work, but it's seldom practical. Okay. Next is retention. Now, retention has nothing to do with us, like regular people. It has everything to do with the company. Okay. Risk retention, whenever you see the word retention, right? Retention means to hold it in, to keep it. So risk retention is the planned assumption of risk by the insured through the use of deductibles, co-payments, self-insurance, okay? Basically, right? The insurance company is going to charge us co-payments. Think of medical insurance, co-payments if we want to go see specialty doctors, right? Why they do this? They're trying to retain profits, keep their profits. These specialty doctors are expensive and they don't want people going unless they really have to. So if someone has to pay a $50 copay every time they go to this specialty doctor, they're only going to go when it's absolutely necessary. It helps retain funds. Okay. Same with car insurance, right? If you have to pay a $500 deductible every time you take your car into the shop for any kind of crash, right? You are not going to take that car to the shop for a baby bumper, like a scrap or a scuff. You're not, because it's going to cost you $500 deductible, right? Because you're taking on some of the financial responsibility. You're only going if your bumper's missing. Right? Like if I have to pay $500 deductible, I'm going if it's dragging on the floor. I'm not going if it's just a scuff. I'll fix that myself. Right? Maybe it's just me. But that's a way of risk retention. Okay? Retaining funds. That has nothing to do with us. It has to do with the insurance company. So the ways that they can do this is by charging co-pays, right? Deductibles, or having you pay for self-insurance, basically. Okay, it puts more responsibility on the insured person, and so they're less likely to use it as often. Lastly is reduction. We're going to reduce the chances that a loss can occur. So because we can't entirely avoid risk, what we do is we put little things around that help reduce risk. Perfect example are smoke detectors, right? We can't really control if there's a fire sometimes, like fires happen, right? But if we have a smoke detector that alerts us when the fire is really small, we're able to reduce the chance of our whole house going up in flames, right? When it comes to our lives, right? Think about seatbelt, the beeping thing in your car that like won't stop beeping until you put your seatbelt on, right? It's like bing, 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 and it's annoying. That is a form of reduction. It reduced the amount of people dying in car crashes because of not wearing their seatbelts. It's psychology. It's literally, I learned about that. It's cool. That reduces the chances of a loss occurring, right? So smoke detectors are a form of reduction, right? Seatbelt monitors in your car are a form of reduction. Annual checkups at your doctor, form of reduction. right? If we're getting an annual checkup every year, right? The whole works, blood work, the whole thing, they are more likely to catch something like cancer when it's really small, right? Instead of waiting and never going to the doctor. Like we all know those people that like don't ever go to the doctor until their like leg is falling off, right? That's because they weren't warned years prior that they had some kind of issue. Okay, so reduction, going to the doctors, that's a way to reduce the chances of something coming up. Changing our diet and our habits, right? Going to the gym and eating more salads. No one wants to do it, but we do it to reduce the chances of heart disease and obesity, right? It's just facts. So that is reduction. We do need to know these for our test. So rewind me, take some notes. Okay. Ideally, insurable risks. Now, there are, I'm going to say requirements. There's guidelines when it comes to paying out. Okay. Insurance companies do not just want to be flinging money everywhere. They don't do that. They're very picky. Most companies. Primerica is very good. Okay. They are very lenient. They pay out like they're good to their policy owners. Okay. I've seen companies that literally any little thing is off and they won't pay. Right. So we are lucky to be working with a very great company that really does stand by their policy owners. So pure risk is the only form of risk that is insurable. Okay. The only form of risk that is insurable. What are pure risks again? Risks that are only loss, no gain. Okay. So death, crash, house fire, all of that. Okay. These are what needs to happen. So first, and I'm going to kind of fly through these, jot them down. It's not going to be the hugest thing, but we do need to know them. First, the loss must be due to chance. It has to be accidental in order to be insurable. Okay. Our beneficiaries cannot plan to kill us and then expect to get that money. Okay. It has to be due to chance. Now, there is the suicide clause that's different with Primerica, but we're not going to get too far into it. Just know the loss has to be accidental. For this part, that's what we're going to go over. Second, the loss must be definite and measurable. Okay, what does definite and measurable mean? It means that there's no going back from it. Like a house fire, that's definite. Like it happened, it's visible, it's there. Okay, there's evidence, right? And measurable means they need to be able to measure how much this is going to cost to replace. Okay. With life insurance, that does not really make sense, but you have to remember we're getting our license for life, I think it has like life, auto, health, and annuities, right? Like it has little bits of insurance in general. It's not just life insurance. So it has to be definite and measurable. Okay. Cost must be definite and measurable. Sorry, my video cut out. It has to be definite and measurable, meaning there has to have answers to as for cause, time, place, right? And how much it's going to cost to replace it. So like I said, in life insurance, this might not make sense, but in other types of insurance, it does. So we need to know what that means. Okay. Next, we have the loss must be statistically predictable. Like I said, insurance companies are businesses. So they have to be able to predict loss. They need to be able to see it coming. The figures have to be there. Okay. So it has to be statistically predictable. This allows insurers to estimate the average frequency and severity of a loss. Okay. It helps them plan ahead for it. Next, the loss cannot be catastrophic. Okay. Catastrophic means something like a big loss, so much loss, right? So insurers typically will not insure risks that will expose them to catastrophic losses. What are these catastrophic losses? Normally, it is war, right? Acts of terrorism. Those kinds of things are called catastrophic losses. Now, with Primerica, it's different. Okay, we have a war clause. That's correct. It's good. But a lot of companies back out when there's wars. When we declare war, it allows a lot of companies to say, nope, we're not going to cover any of the deaths that happen. Same with acts of terror. So like I said, we work for the best company, but when it comes to the list of criteria, we're still going to have that in there. So the loss must not be catastrophic. Okay. The loss exposure to be insured must involve a large homogeneous exposure of units. You probably won't see that on your test, but basically, once again, the loss needs to be statistically predictable. They need to be able to predict this based off of a large group of people, not a 1 in a million kind of thing. But like I said, not really going to apply. And then lastly, the insurance must not be mandatory. Now, in our heads, we think, oh, it must not be mandatory for the person to buy it. No, this one is talking about the insurance company. They must not be forced to accept you. Okay. They have the ability to deny you, meaning it's not mandatory for the company to accept you. Okay, so the insurance must not be mandatory. An insurer, the company, must not be required to issue a policy to each applicant applying for coverage. They must have the ability to accept or deny people at their discretion. Okay. All right. Next, we're going to talk about insurable interest. You are going to hear so much about insurable interest. Okay, so much. Insurable interest is like the base of insurance. Okay, so to purchase insurance, the policy owner, the person who purchases and pays for this policy, must face the possibility of losing something of value in the case of this insurance policy, okay? In the event of a loss. This is called insurable interest. In life insurance, insurable interest must exist between the policy owner and the insured person, okay? At the time of application, and you need to know that right there, okay? In insurance, insurable interest must be present between the policy owner and the insured person, the person whose name is on the policy, right, being insured, at the time of application for it to be valid. Okay? Why? You might ask. So let's just say, like, a stranger cannot just say, hey, I would like some life insurance on my neighbor because he seems like he's going to croak soon. He's going to die. Like, I'm going to get some money off of that. That's not okay. You cannot do that. Okay. I believe that's called a STOLI policy. Stranger originated life insurance. STOLI policies. Okay. And you might see that on your test as well. Those are policies where there is no insurable interest, and that is fraud. Okay. It's fraud. So insurable interest has to be there between the policy owner and the insured person at the time of application. Let's just say a husband and a wife get insurance, right? And they get divorced later. Now they don't require each other's funds, but they keep the insurance. That's okay, because at the time of application, there was insurable interest. Okay. What is insurable interest? Insurable interest would be like, I require this person to survive, or I would be at a loss financially if this person passed away. Okay. I don't like using my family as like examples, but let's just say like my husband and myself, right? My husband pulled out a policy on me because he would have to pay funeral expenses. He would be at a loss. If I passed away, he would have no one to care for the kids, right? He would have not me, and I'm amazing. So he would be at a loss. He would be at a loss. So in order to prevent this, he gets insurance. This is insurable interest. Okay. It can exist between a husband and a wife, right? Parents and children, children and parents sometimes, right? Anybody in that kind of boyfriend, girlfriend, some kind of, they require each other to get through life, or they would be at some kind of financial disadvantage if that person passed away. So that is insurable interest, okay? Okay. Another one is like a business partner, a key employee, right? Like there is insurance for businesses as well. So let's just say like a business, they need this person to run smoothly. That's insurable interest. Business partners, that's definitely insurable interest. If one passes away, the business would suffer. So anything like that, they need each other, they require each other. Okay. All right. Indemnity. So like I said in the beginning, we were going to come back to this. So indemnity can be seen as reimbursement. Okay, we're going to talk about this car reference again. We have a car, right? Let's just say it's worth like $90,000. No, scratch that. We're not even going to put that on it. I have a car. It's not damaged, right? Just a basic standard car. And I go and get into a car accident. They are going to do their best to give me the same thing, if not some kind of financial equivalent to this car. They're not going to give me more than what this car is worth. They're not going to give me less. Well, they're not supposed to give me less than what this car is worth, right? That is indemnity. Indemnity, right? This is a provision in the insurance policy that states that in an event of loss, right, an insured or a beneficiary is permitted to collect only the extent of financial loss, and it's not allowed to gain financially from it. Okay. Let's think about life or health insurance really quick, right? If our medical bills only cost $150,000, they're not going to give us $160,000. They're not going to give us like a $10,000 tip on the side. No, they're only going to give us the extent of the loss and nothing more than that. Okay, so that is indemnity. Next, we have utmost good faith, and then we are done, guys, with chapter 1. So utmost good faith. This principle means that there's not going to be any fraud. There's not going to be any lying. There's not going to be any misrepresentation or concealment of information between parties. Okay, let's go over some of those words. Fraud, always intentional. So we'll be going over that more a little bit later, but fraud is always intentional. Misrepresentations are things that are spoken that are not necessarily correct or true, right? Kind of like lies. Concealment is the withholding of information. Like, you know, you have a felony DUI and you don't tell us. That's concealment. Okay, just not saying it at all. So none of that is going to happen. The utmost good faith basically means that the insurance company and the policy owner need to be able to trust one another. Okay, the insurance company needs to trust that we are going to be honest, and we need to trust that the insurance company is going to pay out when a loss occurs. Okay, so that is the end of chapter 1, guys. I hope you guys all learned something. Go and take a couple chapter quizzes to follow up this video. And yeah, get on your hours, get on your quizzes, and I hope this helped.